Hi, everybody. Welcome. This is another monetary policy update from Bentley University. Remember, our YouTube channel is Bentley University EC 391. We have a number of very helpful videos, we think, on various aspects of monetary policy. So since our last update in September 2020, a great deal has changed, and we'll trace through some of this. So we have three agenda items today. We'll go through the evolution of the U.S. economy since the COVID shock. We'll talk about what's happening with monetary policy tools, and we'll talk about some current policy questions. So the evolution of the U.S. economy since March of 2020 has been very, very dramatic. The National Bureau of Economic Research Business Cycle Dating Committee, yes, that's an official group of economists, they went back and they looked at the data and they decided that the recession began in March of 2020 and ended in April 2020, so only 2 months, and that is by far the shortest recession on record. The next shortest one, I think, is 6 months. And the current expansion began in May 2020. A lot of progress has been made. The overall idea here is that the bounce back has been dramatically faster than the bounce back after the Great Recession. We have a visual here in a minute, but we still have a long way to go, and there's still a great deal of risk. So this is a chart of real GDP, and you can see over toward the right, the gray shaded bar area is the period of the recession. That's March and April 2020, and you can see the dramatic drop in real GDP and the dramatic bounce back. In fact, it only took a few quarters for GDP to rise above its previous pre-COVID peak. But if you sort of extend the trend line here, is you can see that we're still sort of below what we would have been had the economy not been interrupted by the COVID shock, even still, the progress has been very material. On the employment front, gains have also been very dramatic. So again, you can see here over on the right, the precipitous drop in the level of employment in March and April, and again, a very dramatic bounce back. But notice that we haven't even come close yet to hitting the pre-COVID peak. And if you again did the same simple move we did in the last slide, simply carrying on the trend, we are still well short in terms of the level of employment that where we would have been, again, had we not been interrupted by COVID. What the improvement in the bounce back in GDP suggests, combined with the not quite bounce back in the labor market, that suggests productivity. In other words, the output per remaining worker has increased very dramatically, and that's a positive sign for the overall economy. The unemployment rate, unsurprisingly, at the very beginning of the pandemic in March and April, skyrocketed. Since then, it's declined again very dramatically, and we're down to 5.4%. So at least based on the unemployment rate, we've made material progress, but there's still a ways to go. And we'll talk about in a few minutes here that perhaps the idea that the economy is close to being fully healed, we're not quite there yet. So, for example, this is the labor force participation rate. That's the sum of people who are employed plus the people who are unemployed over the civilian labor force. Excuse me, the civilian labor force. And as you can see here, right at the beginning of COVID, again, the civilian labor force participation rate declined very dramatically, several percentage points, and that translates into millions of people. Now, it has bounced back initially, but notice that overall it has stalled out, even with the dramatic increase in level of employment and the overall improving economy. If we look at a slightly narrower version of the labor force participation rate, the prime age participation rate, this is for people between 25 and 54 years of old. These are folks who've generally finished school and who are not yet of retirement age. Again, just like the overall participation rate, it fell dramatically, it bounced back, but notice here in the last few months, the participation rate of prime age workers is starting to improve pretty significantly, even though we are still down several percentage points. And again, that translates into millions of people who are still not fully back into the labor force as of yet. There's a lot of things going on right now. So the idea is it's extremely difficult to get a solid, clear read without much noise on exactly what's happening with the labor market. So for example, overall turnover, or churn, is extremely high. Lots of people are quitting their jobs. There's a record high number of job openings, and a lot of people are retiring. And part of those retirements have been captured in the overall labor force participation rate declining. And so it turns out there's probably a number of factors that are holding the labor market back. And these are probably, apply to individuals, or some apply just to individuals. Some, maybe multiple of them apply to certain people. So fear of COVID, many workplaces, even though there are increasing vaccination rates and so forth, require contact with the public. And some people view that as too risky. Lots of people have moved. They moved back with family and are in the process of perhaps finding a job in their new location. Some types of jobs are going away. Consider, for example, a lot of retail jobs are likely to never come back. We have lots of new jobs being created in, say, for example, Amazon warehouses. And the idea here is we might have skill mismatches and location mismatches. Likewise, COVID has been very hard on childcare and schools, and many of them have closed for very obvious reasons. And that makes it very difficult for working parents to arrange for people to be able to take care of their children, and that's caused substantial labor market dislocation for some people. Unemployment benefits have become longer lasting and more generous, though those are about to expire for the most part in early September. And for many people, those benefits paid higher than what they would have been able to earn otherwise. And so perhaps that kept some people out of the labor force, or at least slowed down their looking for a job, though that's certainly not true again for everybody. Changing preferences for work. People have taken the pandemic as an opportunity to sort of reevaluate where they want to live, the kind of work that they want to do, and so forth. The willingness, for example, to accept certain level of pay. So the point here is that all kinds of things have changed in the labor market. And so it's really, really hard to get a clear picture. And we can show some of this with our trusty agri-demand, agri-supply model. And so on the vertical axis, we could put the rate of inflation, commonly shorthand the Greek pi there. The horizontal axis, we can put the level of real GDP, usually denoted with capital Y. So here, the vertical line, remember, is the long run aggregate supply curve. And so we'll call this level of real GDP Y star. So this is the maximum sustainable level of GDP the economy could make with a given level of resources. We have the aggregate demand curve, which, remember, can be thought of something like the sum of consumption, investment, government spending, and net exports. And again, I apologize for my bad left-handed handwriting. And then we have our short run agri-supply curve. So if the economy is at maximum sustainable employment and is achieving the Fed's 2% inflation target, they would be at something like point A. So if the Fed is achieving both components of its dual mandate, inflation at around 2% and maximum sustainable employment, we'd be at long-run equilibrium at point A. When COVID came along, this caused a number of factors to happen that dramatically shifted the aggregate demand curve back to the left. People stopped going out, they reduced their spending. Moreover, there were factors impacting short-run aggregate supply. Businesses were closed, raw materials and other factors were scarcity. And so as a consequence, the short-run aggregate supply curve also shifted back to the left. And so what happened is we ended up with a lower rate of inflation and a lower level of real GDP. So we are at, in like March, especially April, we are at something like at point B. Well, since then, since the economy's recovered, the aggregate demand curve has moved very dramatically back toward its original position. We're probably not there yet, but we're gaining on it. But the short run supply curve, though, and I won't draw this because the graph is already complicated enough, has shifted back toward the right, but not very much. And so the idea is, and we've got visuals of this here in just a second, is we have inflation, at least for the now, being pushed above 2%. So this is above the Fed's inflation target of 2%. Again, we'll talk about that here in just a minute. So in terms of the evolution of monetary policy tools, the Fed, the bottom line here is they pulled out all the stops. They did roughly as much as they could possibly do. Now, we've covered what they did in a lot of detail in both our March and April 2020 monetary policy updates. And so I won't go into the gruesome details here. The general summary is they did four things. They pushed their federal funds target down to their lowest practical level, that's 0 to 0.25%. They restarted large-scale asset purchases, LSAPs, commonly called QE, quantitative easing, and they're currently running at $120 billion per month, with $80 billion of that in treasuries and $40 billion in mortgage-backed securities. They restarted a number of lending facilities from the 2008 Great Recession, and they introduced even some new lending facilities, recognizing that this is a slightly different problem that they had to face. And then they've also been relatively aggressive at using forward guidance with both respect to the large-scale asset purchases, the conditions under which they would continue those, and the federal funds rate, the conditions under which the federal funds rate would stay low as well. So we can visualize some of these. So here is the federal funds rate, and you can see that just prior to the COVID problem, the Fed was on a tightening cycle where they were very slowly raising the federal funds rate to try to maintain equilibrium in the economy as the economy continued to improve from the Great Recession. But then, of course, COVID hit, and even before COVID, they had started to lower the federal funds rate in terms of what the Fed said at the time was a mid-cycle correction. But then you can see right here, as soon as COVID hit, they immediately dropped the federal funds rate down to the zero lower bound, and it's likely to remain there for quite a bit of time. So here's the Fed's balance sheet. Right now, they're, as we noted, doing $120 billion a month in large-scale asset purchases. And you can see that from the Great Recession, 3 separate rounds of QE, so this is QE 1 through 3, dramatically impacted and increased the size of the balance sheet. And then right here, we have the initial response to the COVID crisis, where the Fed was buying about $125 billion of securities per day. And now we're kind of, at least for the time being, in an equilibrium of $120 billion per month. And so the Fed's balance sheet has recently crossed $8 trillion. In terms of the various lending tools, I don't have them all pictured here. There's even more than the ones that are shown here. This is just a quick visual from the Cleveland Fed. The idea here is that relative to the use in the Great Recession, shown over here on the left, the various liquidity provisions for what they call key credit markets. So for example, this is the, where are we here? Oh, the term asset-backed lending facility, the TALF, the asset-backed commercial paper facility, and so forth, is that these were not nearly as important, at least initially, at least in terms of as measured by take-up, as the Great Recession. So you can see that some of these facilities were certainly used, but again, not nearly to the scale as during the Great Recession. The idea here was that overall, the US financial system was not as hard hit as it was during the Great Recession. Yes, there were problems, and there were material problems, but they were not as widespread, and they were not as bad as they were during the Great Recession, of course, and that's very helpful. And in fact, specifically, only one of them, the dollar swap facility, and this is with other central banks, that's the only one that remains actively in use. All the other ones either ended at the end of 2020 or at the end of the first quarter of 2021. And as noted, the take-up was very mixed. Some facilities were used pretty heavily, some were used not at all. But overall, the use was substantially lower than the Great Recession. And again, as noted already, and this is very important, is one reason the US economy has recovered more rapidly than it did after the Great Recession is because the financial system was able to bounce back much more quickly. And economies that have robust financial systems, on average, bounce back much more quickly from recessions than do economies without a robust financial system. So as a visual here is what we've got is this is the St. Louis Financial Stress Index, and they use 18 different indicators of various financial market indicators. For example, credit spreads between safe assets and risky assets, measures of volatility and so forth. And the idea is to combine these into a single index to give us an indicator of, gosh, what's going on in the financial market. And higher values of stress indicate things are worse. And so here you can see this is the increase during the Great Recession in 2008, 2009. And then here's the increase during the COVID pandemic. As you can see, it never reached the peak that we saw during the Great Recession, and it bounced back much more quickly. And again, based on the St. Louis Fed Stress Index, the financial markets have bounced back to pretty normal levels in terms of credit spreads, volatility, and factors like that. The Fed has also made some interesting adjustments to their interest on borrowed reserves and their overnight reverse repurchase rates. By the way, the interest on borrowed reserves, that's a new term starting in July. It used to be called interest on reserves or interest on maybe even on excess reserves, just as a little note there. And so back in March 2020, when the Fed pushed the target rate of the federal funds rate down to 0.25%, the way they do that is they adjust the interest on borrowed reserves in the ONRRP rate. And these are now set at, or were set at rather, 0.1% for the IORB and 0% for the ONRRP rate. And note that we have a series of videos, in fact, a specific channel, a playlist to show exactly how the reserves market works. So I'm not going to go into the details here. And what's been happening, there's been a lot of dynamics in the market for reserves, is that the IOR rate, the IOBR rate, used to be kept at the top range of the Fed funds rate, 0.25% right now, but they pushed it downward. And what was happening was that for a while, that there was a lot of upward pressure on the federal funds rate and all short-term interest rates from the large impact of Treasury bill issuance. The government was borrowing a lot of money, selling a lot of Treasury bills. That was putting downward pressure on those prices, but upward pressure on those interest rates. Well, recently, since March 2020, thanks to central bank actions and fiscal actions and so forth, we are up to our eyeballs in liquidity. And so what's happening is there's lots of downward pressure being put on short rates, including, and this is important here for the Fed, the federal funds rate. And so what the Fed did very recently was they increased the interest rate on borrowed reserves by 5 basis points and increased the interest rate on the ONRRP rate also by 5 basis points. And the intent is to keep the federal funds rate around the middle of its 0 to 0.25% range. And helpfully, that's worked. We got the visual here in just a second. And also, I got the visual here on this too, is that the take-up, the use of the ONRRP facility has dramatically increased. So here's the federal funds rate. And you can see that this is the point right here where the Fed increased the IOBR rate and the ONRRP rate. And you can see that prior to that, the federal funds rate was drifting well below the midpoint of where the Fed was trying to target it. And after that, notice the Fed funds rate is up to around 10 basis points, or in other words, pretty close to the midpoint of 0 to 0.25%. As you can see here, again, this is the take-up, this is the use of the ONRRP facility. And as you can see, the way the scale is over here on the left is 1,000 corresponds to $1 trillion. So roughly $1 trillion take up use of the ONRRP facility. So financial institutions are taking advantage of the fact that they can now earn, instead of 0, can earn 5 basis points. So at their July meeting, the Fed introduced 2 new what are called standing facilities. These are standing lending facilities. And the idea here is that these facilities can, in the event of any financial market problems, automatically start to work. They don't need to be authorized or approved, which of course can work to create a little bit of delay. So as soon as there's any financial market issues, these facilities stand ready to help calm financial markets. We'll explain how they do that in a minute. And the idea is that what these both are, they're sources of liquidity to financial institutions and other central banks. And also, just as importantly, they encourage the holding of treasury securities. And I'll explain why in a second here. So we've got two of them. So first we have the SRF, the standing repurchase facilities. And so this is available to the primary dealers, and these are the major financial institutions that the Fed generally does business with. And this takes treasury securities, agency and mortgage-backed securities as collateral. So primary dealers put those up as collateral, and they can borrow at 0.25%. And so that's above normal short-run interest rates right now. So there would be a penalty if the primary dealers borrowed from this repurchase facility. So they don't, since there is a penalty. So this is only designed to kick into gear once short rates see upward pressure. And then the current limit, and this can be changed also, they can make loans of $500 billion. And again, if there were serious problems, that could be upped and could be upped dramatically. Then you have the Foreign and International Monetary Authority standing facility. And this is an equivalent that's available for other central banks. So the Fed, in other words, can lend dollars quickly with collateral, of course, quickly to other central banks. The idea being that dollars are heavily used in the rest of the world. And during the early period of the COVID problem, US dollars were exceptionally scarce. And so the idea here is to make sure that dollars are available. Same current rate, 0.25%. So this is above normal market rates. So these facilities are currently not going to be in use because it's cheaper for the primary dealers and other central banks to borrow in normal market conditions. And each central bank can, at least right now, borrow up to $60 billion. So again, that can be expanded. And here's why these two standing facilities are important, is that the primary dealers and other financial institutions are less likely to dump or get rid of or fire sale treasuries in the event of financial market problems, because they know that they have the ability to use those securities as collateral for emergency loans from either the standing repo facility or the FEMA facility. And so what central banks in these institutions will do is they're more likely to hold on to their treasuries and their agency and their mortgage-backed securities and prevent a wide-scale selling of these and prevent downward pressure on prices and prevent upward pressure on interest rates. Just as a quick aside here, is that overlooked in all the action during the COVID crisis is that March 2020, the Fed changed the definition of the M1 money supply that we all learn in going all the way back to standard principles of macroeconomics course. And so the old definition was coins and currency in circulation, checking account balances, and that's most of it, and then small component of traveler's checks. The new definition includes all of those things, plus savings accounts and money market deposit accounts. And these two, savings accounts and money market deposit accounts, these used to be included in M2. So they're still included in M2 because M2 includes all of the things that are in M1, but now they've been shifted over to M2. And so, why did the Fed do this? Why did the Fed expand M1 to include savings accounts and money market deposit accounts? Well, part of it is effectively about a reality. Thanks to modern technology, it's very easy for people to switch funds between checking and savings accounts. And so as a consequence, savings accounts used to be not very spendable. It was relatively difficult to access those for spending purposes. Now, they're approximately as spendable, so to speak, as checking accounts. So it's effectively, again, bowing to reality here. in March 2020, one of the other things that the Fed did is they eliminated reserve requirements on savings accounts. So there used to be a 3% reserve requirement on savings accounts from March until 1992. Those were pushed down to 0. Then what they did, in again March here, make sure I've got this right, the checking account reserve requirement went from 10% to 0%. So that matched the reserve requirement on savings accounts, which again had been pushed down to 0 in 1992. So they were treated the same. And then finally, there's a relatively obscure regulation, Regulation D, that has been eliminated, and that regulation limited withdrawals, how frequently people could make withdrawals from savings and money market deposit accounts. And so the idea is, again, savings accounts and money market deposit accounts became much more liquid, and so the Fed thought it was reasonable for them to be included in M1. And so here's a visual, and so you can see that M1 skyrocketed as money market deposit accounts and savings accounts were added. But notice that, of course, M2 didn't respond in kind simply because those assets are already included in M2. And so if you're looking for a way to measure or visualize the extent of the Fed's expansionary policy that they undertook during COVID on the money supply, it's much better to use M2. So yes, the money supply has increased very dramatically from roughly $16 trillion, a little bit less, to now north of 20 trillion. It's not appropriate to look at M1 simply because of the definition change. So what are the current monetary policy questions? Well, we've got 3 of them. So right now, as we noted earlier, we have a relatively elevated inflation rate. And so is this a temporary situation or is it more permanent? How do we measure the state of the labor market? We've already talked a little about this. And then what might the taper, meaning what might the slowdown of the current large-scale asset purchases, what might that look like? So Jerome Powell has characterized the current rate of inflation to be, quote, and I'm using his direct quotes here, this is from his most recent press conference and his speech, his recent speech at Jackson Hole, well above 2%, but that it's transitory, in other words, temporary. And his general argument is that you should expect to see a strong bounce back in inflation as aggregate demand rises, thanks to the reopening of the economy, and the relatively slower response of short and aggregate supplies we demonstrated a few slides ago. And so his contention is that, well, aggregate demand growth will become more normal. And once all the various supply chain blockages, like, for example, chip production and so forth, once those issues have abated, the current, well above 2% inflation should decline back toward the Fed's objective of, again, of 2%. So here's the visual. This is the personal consumption expenditure measure of inflation. This is the Fed's preferred index. So you can see that the initial stages of COVID, unsurprisingly, is the demand for various spending categories, hotels, airlines, and so forth declined. Inflation declined pretty notably. But then once the economy started to open up, and you combine that with some supply chain issues, both the headline, which is the blue line, and the core, which is the solid red line there, both of those picked up pretty notably and are, as Chairman Powell said, well above the Fed's current 2% objective. But if you look at other measures of inflation, the impact isn't quite so dramatic. So this is the trimmed mean PCE. And the idea is that it's calculated by throwing out the highest categories in terms of goods and services that are seeing price increases, and the lowest categories in terms of seeing price increases of goods and services, and calculating price increases of goods and services around the center of all the goods and services that are in the measure of the price index. And you can see here that both the initial decline in response to COVID and the bounce back have been much less dramatic. And notice what's critical here is around 2%. In other words, the prices of goods and services around the general center have moved roughly in tandem with the Fed's 2% objective for the last several years. And so we can think about this a little bit more deeply here. So if the idea is that if inflation is being caused by a very expansionary monetary policy, and it will be more long lasting, that what we should observe is price increases to be very spread out. In other words, price increases of most, if not all, goods and services. But what we observe, and this is suggested by the trim mean calculation we had in the previous slide, is what we see is that inflation is very concentrated in relatively few goods and services that are related to the reopening of the economy, supply constraints, or perhaps some combination of both. So as particular examples here, we've seen hotel rates rise. We've seen car production being limited by not shortages of steel or other goods, but of computer chips. And then more broadly, aside from cars, durable goods in general. And I've got a good visual on this on the next slide. The other angle to take here is that if inflation was expected to be more long-lasting, more permanent, inflation expectations should also be increasing. Now, as again, I've got visuals on this here too, and they have definitely come back, but they are notably much lower than the current rates of inflation. All right, so first, let's take a look at the durable goods. And so over on the right here, you can see that very recently, the rate of inflation for durable goods in the consumer price index is up nearly to a rate of almost 15%, and that's very dramatic. Okay, but as you can see, looking from a much longer point of view, is that on average, there's been a lot of downward pressure on durables prices, competition, improved productivity, and so forth. So it's highly unlikely that this very, very dramatic increase is going to be persistent. In terms of expected inflation, if you ask households and you survey them about, gee, what do they think inflation is going to be over the next year? Now it's around 5%. And that's, of course, that would be consistent with being well above the Fed's target. But if you ask financial market participants in terms of their pricing of particular financial assets where you can back out expected inflation. So what this is, and we won't bother with the details here, based on treasury prices and TIPS prices, those are treasury inflation protected securities prices, you can back out what's called the 5-year break-even inflation rate. In other words, the average expected inflation rate over the next 5 years. And you can see that this is hanging right around 2.5%. Again, granted, that's above the Fed's target to be sure. And noted, it's bounced back quite impressively from the lows of the pandemic. But what's important here is this is measured by the consumer price index, not using the personal consumption expenditure inflation. And the CPI is known to be a little biased on the upside for inflation by about maybe 0.3% or so. So if you back out 0.3% from 2.5%, that takes it down to roughly 2.2%. And that would be well within the Fed's objective for the 2% inflation. So again, financial market participants don't seem to think that inflation is going to be long lasting. So how do you measure the state of the labor market? Again, we've talked a little about this. And so the Fed, in terms of thinking about tapering QE, their forward guidance has been, well, we need to see substantial further progress toward the dual mandate before we start tapering QE. At his most recent speech in Jackson Hole the other day, he noted clear progress had been made in the labor market, but that is not the same thing as substantial further progress. So what Jerome Powell is saying is that it's better, but it isn't quite better enough. And one of the answers to thinking about, well, has substantial further progress been made, is has the long-run aggregate supply curve shifted? Now, back a few slides ago, when we were looking at aggregate demand and short run supply, I didn't shift the long run supply curve. Again, the graph was already relatively complicated. But here's the thing, think about the labor force participation rate decline we noted earlier. If those workers don't come back, it's entirely possible that the long run supply curve has shifted and shifted back to the left. Now, granted, some of the productivity increase that we mentioned will likely offset that, but not fully. And so if that's the case, if these workers have dropped permanently out of the labor force, maybe there's more progress than the Fed thinks. And in terms of where the Fed's thinking is overall, is at the July Open Market Committee meeting, there's a very long discussion of when should we taper, how should we taper, and so forth. And most of the participants in the meeting seem to think they want to begin, again, this is under current situations, by the end of 2021. Some folks want it sooner, some folks want it later, but again, it seems to be roughly the end of by the end of 2021. And so what might this taper look like? Well, they're now thinking about tapering. They're now talking openly about it. And so what might it look like? So what they're going to try to do is announce it well in advance. And they've already sort of hinted that this is happening. And what they want to do is in 2013, Ben Bernanke made some almost offhanded comments about the tapering of what was then QE3, and financial markets reacted very poorly. Interest rates skyrocketed, there was a lot of volatility and so forth. And what it will do is it will include reductions in both mortgage-backed securities and treasury buys. In fact, in response to questions at a recent press conference, Jerome Powell specifically ruled out a mortgage-backed security only taper. Some economists have argued that given the very strong housing market, that the case for buying mortgage-backed securities is really pretty weak. In other words, the housing market doesn't really need very much help. So based on past history, we now have some history in terms of what tapering might look like. So the last major large-scale asset purchase, that taper ran from January to October of 2014. And so given that QE4 is on a larger scale, there's a good chance that the period of the tapering is going to be longer, just because they don't want to do it very suddenly. They want to do it relatively slowly. And then at some point, and they're not even, this is important, they're not even thinking about, well, letting the balance sheet run down again like they did for a couple of years during 2017 to 2019. And so in conclusion, the US economy has made quite a bit of progress back from the depths of the COVID recession. There's still quite a bit more to do, though. We've mentioned that, for example, unemployment is still elevated and the labor force participation rate is still down. And sort of one of the major uncertainties right now is the Delta variant of COVID and how it's starting to influence parts of the US economy, especially in the South and parts of the West. And at least as of right now, there's a pretty good chance the taper will be certainly announced by the end of 2021 and perhaps even start by the end of this year. Though again, a more widespread outbreak of COVID and the Delta variant could upend this. All right, everybody, thank you very much.